Taylor sets us up beautifully, always going cross-asset, as we like to do, with Michelle Schneider as well, who can take us forward on this discussion. Market Gauge Group Managing Director. Michelle, it's always great to have you with us. And actually, what do you make of the intraday volatility we've seen today? Because Friday, big sell-off. Europe and the rest of the world seem to catch on to that. But now some of that bearishness basically leaves us flat.
Absolutely, and I think it's pretty extraordinary because, as you know, people get kind of hysterical at these apexes, whether it's bullish or bearish, and that's exactly what happened coming into today. And here we are in the indices holding the 50-day moving average. So clearly we're under the resistance of the pivotal point, or the 50% move from those June lows to the mid-August highs. But nonetheless, we're hanging in there tough. So you have to wonder why. And I heard you guys were talking about the dollar. The dollar is actually a bit softer here. It's very possible, even though it seems illogical, that the dollar may have topped out. And yes, the yields are up compared especially to Friday when it looked like a flight to safety. But there's some interior sectors of the market that are really worth keeping an eye on for next moves. And we're very focused on transportation right now, that sector.
I'm curious if you could double down on the dollar for a second, because what are the ramifications of the peak, and what is the risk of being wrong on a call like that?
Well, in terms of the ramifications of it being at a peak, obviously that would have a double-edged sword. For commodities, it would actually be good in an environment where really we think commodities are still starting this sort of super cycle. For equities, it can be a little bit of a relief because obviously dollar-dominated instruments would be a little bit less costly. So that remains to be seen. Now, in terms of the risk of being wrong, I wouldn't necessarily put like a lot of money onto that bet, but it is something to keep an eye on, especially when you couple it with the interest rates and the yields and the long bonds, how the long bonds are going to perform against the SPY. And again, going back to these sort of interior sectors, the consumer, we have consumer confidence coming out tomorrow, and how the market digests this new, it's not so new, but I'd say reiterated hawkish tone that Powell took on Friday.
So why transportation?
Well, because transportation is sort of the pinnacle way to be able to gauge what's happening with demand. And it covers all aspects, you know, planes, trains, automobiles, if you will. So it's how people are traveling, how goods are moving, how freight is moving, how consumers are getting goods delivered through FedEx and UPS. And so I have seen through the years where people get really bearish as IYT is bottoming out. And I like to use that particular ETF because it covers the bases. And so it's forward thinking. Remember, this market, we have some money coming in from the government for infrastructure. So it could be, and it might seem like an aberration, but it could be if transportation can hang in there, things won't be so bad as we go into the next quarter.
Michelle, what do you brace for as we head into the next quarter? We know August, September can be pretty ugly months in general. Do you just sort of anticipate that, find the right hedges, or do you look for opportunities?
Well, we're pretty positioned now in a few areas. I still believe, and I know I may sound like a broken record on this, but that gold and silver have to be bottoming at some point compared to the rate of inflation, and of course compared to how they are relative to, let's say, the Dow. If you go back 30 years, the Dow is 30 times greater than the gold is right now in terms of ratio. Number two is we're very focused on the drought and the real severe weather conditions we're having globally that's wreaking havoc, and what that's going to do to food commodities, which brings me to the third point, and that would really be with food commodities, geopolitics starts to really potentially unravel, because what do people fight over? Food. It's the one thing more than anything. So that's our big caveat there. Not so much the Fed, because the Fed is going to try to waver between data points and inflation. So that's kind of what I have my focus on. So we're positioned in things that could actually benefit from poor weather conditions. So, for example, besides the commodities and the energy markets and the food and the ag markets, we've even looked a little bit into the cannabis market, which has been so undervalued here because of many reasons. But if there's a water shortage in California and we start to see scarcity, that could be an interesting play as well.
Michelle, I'm curious about how much downside risk is left in this market. You saw the reaction on Friday. You saw the uncertainty floating into this week. But what about September, October, into the midterms? How much downside risk is left?
Well, it is possible, obviously, if we break down under the June lows, that we can go down. I've been looking for about 3,500, and the SPX is the rock bottom. I'm not necessarily agreeing with calls for 25% lower or a huge extended bear market. I still think we're in a stagflation environment, which means the economy is not dying. It's just stagnating. So really, it's so much is going to depend on what happens with the overall geopolitics and the overall Mother Nature issues that we're having right now. And if they don't get too crazy, then it's possible we'll stay in a trading range, but we won't necessarily crash.
Michelle, seems like you're sort of in tandem with what Goldman's saying in the moment, the buy the commodities, worry about recession later. Michelle Schneider, thank you so much. Love having you on, as always. Market Gauge Group Managing Director there.